Spot versus futures trading. Two traders both think Bitcoin will rise. One buys Bitcoin and waits. The other opens a futures position with 10 times leverage. Same idea, completely different risk. Today, you will understand the difference before you ever place a trade. First, spot trading. Spot trading is the simplest form of crypto trading. You buy the actual asset at the current market price, called the spot price, and you own it. If you buy $100 of Bitcoin, you now own $100 worth of Bitcoin. If the price goes up, your Bitcoin becomes more valuable. If the price goes down, the value falls. The important part is this: your maximum loss is what you put in. If you bought $100 of Bitcoin, the most you can lose is that $100. You cannot lose more unless you borrow money or use leverage. There's also no time limit. You can hold your Bitcoin for days, months, or years. Nothing forces you to sell. That is why spot trading is where nearly all beginners should start. It's simpler, easier to understand, and generally less risky than leverage trading. Now let's look at futures trading. Futures are contracts. Instead of owning the actual Bitcoin, you are making a trade based on where you think the price will go. You can go long, which means you believe the price will rise, or you can go short, which means you believe the price will fall. Futures also allow leverage. Leverage means borrowing to control a bigger position than your own money would normally allow. For example, with 10 times leverage, $100 can control a $1,000 position. This is the part that attracts many new traders. A small price move can create much bigger profits. But there's a catch. Leverage multiplies losses too. With 10x leverage, a 10% move against you can wipe out your entire position. This is called liquidation. Liquidation happens automatically. The exchange closes your trade because your losses become too large for the money in your account to support the position. And in crypto, this happens constantly. Billions of dollars in leveraged positions get liquidated every month. This is why leverage is not a shortcut to easy money. It's a professional tool that requires experience and strict risk management. Here's a quick question. With 20x leverage, how big a price move against you would wipe out your position? Think about it for a second. The answer is just 5%. That means if the market moves only 5% against your trade, your position can be liquidated. And in crypto, 5% daily swings are completely normal. That is why high leverage is so dangerous. The higher the leverage, the smaller the move needed to wipe you out. This is also why most new futures traders lose money. Many people focus only on the potential profits and underestimate how quickly losses can happen. So which type of trading is better for beginners? Spot trading means you own the asset, your losses are limited to what you invested, and there is no liquidation. That makes it ideal for learning. Futures trading is more complex. It includes leverage, liquidation risk, and extra costs like funding fees. Experienced traders sometimes use futures as part of a disciplined strategy, but beginners should fully understand the risks before using leverage. Learn to walk before you run. Master spot trading first, then study futures carefully before ever opening a leveraged position. So here's the recap. Spot trading means owning the actual asset with limited risk. Futures trading means using contracts and leverage, which can increase gains but can also liquidate you very quickly. Before placing any trade, make sure you understand exactly what type of trade you're making. Follow us for weekly crypto education made simple. This content is for educational purposes only and should not be considered financial or investment advice.